In today's video, I'm chatting with Rick Rule about 10 different popular gold stocks. He's going to share with you his thoughts on each one, as well as his ranking on each one. Now keep in mind, Rick has made more money investing in natural resources than just about any person on earth. So this is a very worthwhile listen. In fact, I think you should listen to it twice or 3 times, because every time you listen to it, you're going to pick up more and more details that you didn't catch the previous time. So with that, I'm happy to welcome Rick Rule onto Mining Stock Monkey for the first time. Oh, and stick around until the end, because before the end of this video, you're going to find out how you can get your own natural resource portfolio ranked for free by Rick Rule himself. In 2015 and 2016, the price of gold was about $1,000 an ounce, just slightly more than that. We've gotten a triple since then. Is it time to take some profits?
My suspicion is no, but of course that depends on the individual investor. I suggest that you take profits when you have something better to do with the money. I would argue a bit with your history too. When people ask me when the gold price is going to move, I scratch my chin sagely, and I say, I think the year 2000. In the year 2000, gold was $253 an ounce. Now it's 3,000. So that means the gold is up 12-fold in 25 years. It's interesting that people don't consider 9% compound internal rate of return for 25 years to be performance. I don't think that the problem is necessarily gold so much as investors' perception. In direct answer to the question, I'll be selling my gold when I have something better to do with the money. And my suspicion is that won't be for quite some time. There's some arithmetic that we can get into around that later in the discussion, if you so choose. But the direct answer to the question is my gold is not for sale at this price relative to the other investment opportunities that present themselves to me.
Yeah, that makes sense. In previous interviews, you have said something along the lines of, in the US, the percentage of investment assets in precious metals and precious metals related securities is less than 0.5%. But the 4-decade mean is 2%. And you're a big believer in the reversion to mean, as am I. So that should be a very strong force pushing a lot of demand towards gold. But if I can play devil's advocate on that point, that's in the US. And the US doesn't have a very large gold buying population. Let's compare that to Asia. The US population is 350 million. Asia's population is what? 3 billion, 4 billion? I don't know exactly. And it's very ingrained in their culture to save in gold. So my devil's advocate position on the reversion to mean would be, it's a lot more important what's happening in Asia than in the US. What would you say to that?
3 comments to that. First of all, on a global basis, the median market share of precious metals is closer to 1% than 0.5%. I suspect that's because Americans have access to more investment products and opportunities, which say the global market is more saturated than the US market with regards to gold ownership. So gold ownership as a percentage of total assets has to double in the United States to achieve the global mean. A different point, however, is that the United States, despite its relatively constrained population, something around 340 million people, currently controls between 22 and 23% of the world's savings and investment assets. So a reversion to mean in the United States is substantially more important than a reversion to mean, say, in Bolivia or even China, because the mean here comes with a higher statistical average. The numbers that I cite come from JP Morgan Chase. And JP Morgan Chase doesn't have data to verify it, but they suggest that the median market share of precious metals relative to other asset classes in the United States in 1981, which they defined as the peak, was somewhere between 6 and 7%. So what I'm suggesting in the US, a 2% reversion, and let's make that a global 2% reversion since it requires less of other countries than the United States, that doesn't include the possibility that the market share of precious metals overshoots the mean. Should things like price appreciation and momentum justify the narrative and cause people to pile into gold as opposed to merely to revert to mean. I'm using that number because I believe it's a conservative number.
Yeah, absolutely. Now let's get into some gold stocks. What are your thoughts on Barrick? And does Mark Bristow deserve his reputation as being a great CEO?
I've known Bristow for almost 40 years, so you have to add in some friend bias. I met Mark Bristow when he was part of the original Cons mine in South Africa before the spin out of Randgold and then Randgold Exploration. And I watched him build an Africa-focused exploration company from a standing start over 25 years. The return on capital employed that I and my investors enjoyed in Randgold was almost fictionally good. So I would describe myself as a Bristow aficionado. He's an old school guy like me, which might suggest that he's past his prime. I'm 72. I don't know how old Mark is, but Mark has a predilection not to overpay. He also has a fondness for absolute value, which means that he is inclined to take perceived political risk, which the markets hate. Because I hope I have a few good years in me, hope that Mark has a few good years left in him. And unlike the capital markets, which think his foray into Pakistan, into Reko Diq, is madness at its best. The idea that someone with Bristow's financial skill sets and political skill sets takes on one of the best undeveloped deposits in the world. Obviously, Mark has survived Mali. He survived Congo. He likely can survive Pakistan. Means that I'm attracted to Barrick. I need to say that I only have a small stake in Barrick, which is down from a very, very, very large stake after their merger with Randgold. But in direct answer to the question, I'm increasingly attracted to Barrick as the market's hate for it grows.
I've seen some interviews from Mark Bristow when he's talking about Reko Diq, and he's talking about coming to a resolution in Papua New Guinea with the Porgera mine. And in these interviews, he's been saying, we're splitting it 50-50 with the local economy, with the host country, because these should be 50-50 partnerships. Now, when I hear him say that, I'm thinking, careful, Mark, you're going to have other countries coming for their 50% who are currently getting 20% or 15%. What say you to that?
Except that they're not. What Mark is doing is using honest accounting. Mark is saying that 50% of the benefit of the mine, net benefit of the mine, goes to the host community. So before they get their 50%, he gets complete cost recovery, including his cost of capital. If your cost of capital in Mali is 13%, and he's putting up $2 billion, he's getting back the $2 billion plus 13% cumulative and compounded, and then they split the benefit 50-50. And included in the benefit, Mark is including customs, off-concession capital contributions, as an example, roads and schools. So when Mark talks about the fact that the host country gets a 50, he's talking about a real 50, not a fake 50.
Mm-hmm. Yeah, totally makes sense.
It's important to note that. That includes cost of capital and social rent.
And do you have a ranking on Barrick?
I have banking. I have Barrick as a 5. Right now, the growth strategy isn't clear. We haven't seen the final feasibility study on Reko Diq. We haven't seen what the financial stack will look like on Reko Diq. We haven't seen what the financial precedents are with regards to Pakistan. So it's very difficult for me to build in a lot of Reko Diq in my models when I have no sense of what the assumptions will look like.
And for anyone watching this, any rankings that Rick gives in this video is for today. We're recording this at the end of March. Things can change tomorrow if there's some news event or something something could change any day or any week that totally changes the ranking going forward. So keep that in mind. This is just a snapshot in time.
That's a great point. The other disclaimer is that they represent my own perceptions. I'm an old, fat, experienced, bald, rich guy, and I'm willing to take risk, political risk and exploration risk. For investors that don't have the psychological or the financial wherewithal to stand risk, understand that I don't discount risk in my rankings as much as some people do. So there is an implied risk tolerance in my rankings that might not be appropriate for all investors or speculators.
And it seems to me that five is kind of neutral. You said you own fives, and fours are typically pretty good companies, or when you're getting to a like fairly valued or an attractive valuation. And then is six getting closer to a sell?
Yep.
Okay.
Yep. I own some sixes where I think there's substantial upside, but there's things that need to be fixed before I can upgrade them. If I've identified what the fix might look like, and I think that the company has the ability to effect a fix, I might own a six if the upside is high enough. I don't recommend that other people do that because, again, I have 50 years in this game. I'm absolutely willing to take a loss. I've done it a lot of times in the past. So I'm willing to be more risk oriented in my own account if I like the possibility as opposed to a probability of an outsized upside.
Next question. What are your thoughts on Newmont today? I've heard you express that you like that they're selling off some of their tier two assets to focus on their tier one assets. Do you think that the market might punish them for having lower production going forward?
Hopefully, I'd like to buy some Newmont and I'd like to see it sell off. So hopefully the market will punish them. Newmont missed their AISC estimate 6 straight quarters. And I think they did that because the management team was trying to run too many mines. And some of the mines were completely immaterial to a company producing 5 million ounces a year. When they acquired Newcrest, the deal that they made with institutional investors is that they would rationalize the portfolio, sell off the second tier mines, focus their love, care, attention, and capital on the tier one mines, which was the right thing to do. Their announced target for cash generated by dispositions was just over $2 billion. Thus far, they're $4 billion and counting. And so the balance sheet post Newcrest went from stressed to pristine. At the same time, they are now able to increase their sustaining capital investments at their best projects and focus love, care, and attention on those same projects. I have a small position in Newmont. I will increase it if I see that the love, care, and attention that they are now able to focus on their tier one assets bears fruit. I want to start seeing progress on both the return on capital employed number, which at Newmont is horrific, and the all-in sustaining cost number.
And what's your ranking on Newmont?
Currently, I have Newmont as a 5, restructuring in process.
How about Agnico Eagle? Over the past 10 years or so, they've been able to grow cash flow per share. It was, last I looked, 2 times or 2.5 times over the last 10 years. Do you think they'll be able to do that again over the next 10 years?
At least one more time. There is some optimization which can happen in their existing portfolio. Importantly, their project pipeline is in very good condition. So growth is baked in the cake in Agnico Eagle for the next 5 years. And while they are selling at a premium price compared to their competitors, the quality of their free cash flow and the free cash flow multiple suggests that there's more to go. I have Agnico Eagle only as a 4. It used to be a 3. I downgraded it simply because the stock is up 60% in the last 12 months. I thought that one of the standout performers at my Natural Resources Investment Symposium last year was, in fact, Agnico Eagle. Normally, the standout performer is a smaller, unknown company. And Sean Boyd getting in front of our audience explaining why the stock should double from where it was, but doing it arithmetically, not a whole bunch of narrative about gold's going to the moon or, something like that. It was really, truly a standout piece of work.
What about the fact that Sean Boyd is no longer running the company? And what about the fact that they're diversifying out of gold and into Mexico?
Well, diversifying into Mexico, I think, is really opportunistic. We will see what Ms. Scheinbaum is actually able to accomplish in Mexico. I'm not describing her as friendly to mining, but I am describing her perhaps as a political realist. What she has said is that while she herself is not in favor of open pit mining, that isn't her decision. That in localities where the local community supports open pit mining, that she would take her guidance from the directly affected people. Agnico has a fairly successful history in Mexico, frankly, not as successful as they have in Canada. And I would suspect that increasingly what you're going to see is Agnico's focus will be on cold weather operations, and in particular, operations in the Abitibi. I think their operations in Mexico will be important to Mexico. I'm not so sure that they'll be important to Agnico's.
And how about Sean Boyd no longer running the company? You don't have any concern there?
Not at all. Sean Boyd was mentored by Paul Penna, who stayed on as chairman for 10 years while Paul was getting his feet under him. And I suspect Paul will stay on as chairman for 10 years while the new management team gets their feet under them. I'm cheered because one of the directors there, Peter Grosskopf, is a close personal friend and former business partner of mine. And he describes the board process as particularly robust, meaning that there's no rubber stamps there. Everybody works hard, they work together, but nobody's a shrinking violet. Everybody's willing to come to the party and fight for what they believe is right. And there's too little of that in major mining company boards.
Okay, next, I would like to get your take on Newfound Gold. Today, we got their initial mineral resource estimate. I don't know if you saw this, but between indicated and inferred resources, we're looking at 2 million ounces of gold, a little north of 2 grams per ton. And the stock is down huge. The stock was down 37% on the day last I saw. I was really surprised at how low that number was, that 2 million ounce number, considering just how much money they've spent on drilling. What's your take on that?
That was an amazing stock promotion. Colin Cattell and his team, aided perhaps by my former partner, Eric Sprott, got that market cap to $700 million. And it was very difficult to sustain the expectations that were created. I don't have any comment on today's resource estimate because what I need to do is I need to reconstruct it myself, and I need to see if it's mineable. That deposit so far, or series of deposits, looks to me, rather than being 2 million ounce deposit, to be sort of a string of pearls. And I'm interested to see how you mine it, what the upfront capital costs will be, what the operating costs will likely be. In other words, I need to familiarize myself with the numbers before I comment on them. I've had that stock rated between 6 or 7 on a valuation basis for a long time. And I was unwilling to upgrade the valuation until I saw the initial 43-101. Now I need to put that 43-101 through our own lens, looking at the reserves and resources in mine plan and in cross plan, trying to determine how many of those 2 million ounces we think are mineable. And what that mine or series of small mines might look like.
And now that the market cap has fallen from US 700 million to about US 200 million, is your ranking still a 6 or is that pending?
Pending. Yeah, pending.
Okay.
I mean, I have to say, the more the stock price falls, the more likely I am to upgrade. Because for me, momentum is an irrelevancy. I'm interested in price to value.
How about Equinox Gold? Do you think their merger with Calibre Mining will go through? And do you think there will be a positive resolution at Los Filos in Mexico? Do you have any insight on that?
Two different questions. I think ultimately the merger will go through simply because I think the management team around Calibre wants it to go through. Larger companies enjoy greater trading liquidity, more passive index buying, and hence a lower cost of capital. And in a capital intensive business, a lower cost of capital is a definable competitive advantage. The resultant company will, I think, benefit from having 2 development projects attain nameplate economic capacity, which is to say 2025 will be a substantially better financial year than 2024 was. And 2026 will likely be an extraordinary year. There is, of course, an objection from the largest shareholder of Calibre on a valuation basis. I hope that that investor looks at the transaction from a sum of the parts viewpoint and what they can make over 18 months as opposed to the premium that they had hoped to garner in the interim. With regards to Mexico, my suspicion is that 3 or 4 assets in the combined company will be sold. This is very consistent with Ross Beating's strategy in the past. You start with a group of assets that are a starter pack, and you add on better and better and better assets. And midway through the life of the company, you sell off assets that are redundant to the company. My suspicion is that while Los Filos certainly served its purpose in terms of generating free cash in years past for Equinox, the problem with regards to operating in Mexico and the problems with regards to operating in those communities, including the problems with narcotraficantes, is such that those assets would probably be better sold and operated by a Mexican mining company, a North American domiciled perhaps, but a company like Luca that can operate with Mexican unions in Mexican society and Mexican politics. I don't know that Ross is going to do this, but my suspicion is now that they're bringing their Eastern Canadian asset online and bringing their Abitibi asset online, now that they'll be producing a substantial amount of ounces in Canada, that you will see them look to less marginal deposits. I suspect, I should say, I hope, they'll also sell off the California assets. I think California is a jurisdiction with real political risk, unlike Mexico, where some of the risk is perceived.
So you don't like that Castle Mountain expansion project because of the political risk?
Correct. I mean, I've been involved with Castle Mountain since its discovery, which means I've been involved with that deposit since 1980. It's a lovely deposit, and we're at 8 miles east of where it was, which is to say across the Nevada line. I'd be on that deposit like white on rice. Sadly, although it's in a good county, it's in a bad state.
Okay. We have a subscriber question here. What's your take on B2 Gold with first gold pour from Goose on the horizon?
I'm a B2 shareholder. B2 over time has served me well, although the last 18 months have been truly ugly. The combination of the realization of political risk in Mali, which, by the way, Clive Johnson did a masterful job of, very, very, very quietly flying to Mali and sitting down with the guys and saying, what do you want? What can I give? Where do we meet? No fuss, no muss, no headlines, no hate. Between that and the eventual completion of the Northern Canadian project, and by the way, first pour is a long way from economic completion. They're going to have to shake that thing in. You're not going to see what that mine can actually do until 6 or 8 months after first pour. But I've watched Clive build mines since the Bema days. I've watched him build mines in Siberia. I've watched him build mines above 4,000 feet in Chile. He and his team are uniquely good at challenges like this. Are they behind schedule? Yes. Are they over budget? Way over budget. Way over budget. But I'm reasonably certain that they will bring this project in and that the project on an AISC basis at least will be as good as they had suggested it will be. On a return on capital employed basis, the fact that you're almost a year behind schedule suggests that the return on capital employed won't be as good as initially estimated, but the stock is way, way, way down. So the market's already discounted that miss in return on capital employed. Your risk there, really, by there, I mean B2, is that Clive is my vintage, well past his prime. Can he continue to maintain the pace? Is he interested in maintaining the pace? If he isn't interested, what happens? Does it get taken over by somebody bigger? Do they put in place a new management team? And how does that new management team perform?
When you say they're way over budget at Goose, they are, but I feel like they could have done their budget at a lot lower level, but because they chose to massively de-risk the project, they chose to spend more. Like if they were a cash-strapped junior, yes, they could have done it for a lot less money. But when you look at the logistics of that mine and getting things to site, if something big breaks at the mine, they have to wait for that thing to get manufactured or get delivered to them. And then they have to wait for the ice to melt to bring it in on a barge to the marine laydown area. And they're going to be doing that sometime around like late summer. And then as you get into winter, like around March or around January, they're going to build an ice road from the marine laydown area to the mine site. And then they're going to ship that thing on by truck over the ice road in March or April. So if something big breaks at the site, it could literally be a year before they get a replacement to site because of the logistics of it. So you have to have a replacement for everything that could go wrong. And you have to have a huge increase or like a huge reserve of consumables like diesel fuel and things like that. So what are your thoughts on that?
Two comments. One, they've known that since the beginning. And had Clive gone to interviews and analyst conference and said Bruce McLeod did a wonderful job with this, but he was cash constrained. We're not. We're going to build it right. And here's our new capital cost forecast. Then nobody could say it was over budget. Had he presented a budget knowing what you just said, he wouldn't be over budget because he would have guided to a realistic budget. I don't think they wasted any money up there at all. I think they're really, really, really good builders. Either they accidentally misled the market or they misled themselves. Now, with regards to production efficiency, I've watched Clive for 40 years. I think exactly what you said is exactly what's coming to pass. They are building in a margin of safety, given the remote nature of the operation. But the truth will come after 2 years. The truth will come in the numbers. What will the all-in sustaining costs be at that operation, given the extraordinary grade, but the location challenges? What you say is one thing that might occur, and the arithmetic will show us in 2 years what did occur.
And do you have a ranking for B2 Gold? And I also forgot to ask you for your
I,
ranking on Equinox.
I currently have both B2 and Equinox as fours. I think Equinox may sell off as the acquisition of Calibre is completed and the Calibre shareholders who were owning that stock for an acquisition sell on the attainment of their goals. So I think there's going to be near-term price weakness in Equinox for structural reasons. What I like about B2 is just that it's hated. This is a high quality group of people who are quietly resolving the two reasons why the market hates them.
You talked about Clive going over to Mali and talking with them quietly and coming to an agreement basically before anyone else did in the country. And you can see how that turned out for Barrick and how it turned out for Resolute Mining. Not great. So it was very good that Clive got that taken care of first. But in an interview a few months back, you said that you were trying to arrange a visit to the three Sahel states, Mali, Niger, and Burkina Faso, and meet with the leaders there and try to get like your in-person take of what they see as the future of mining. Is that still in progress? And if you made any headway on that?
I've made no headway whatsoever. I managed to meet with a representative of the government of Mali at the Prospectors and Developers Association meeting in Toronto a few weeks ago. And the truth is, the problem is more mine than theirs. I am simultaneously, as you probably know, building a bank called Battle Bank. And my own business is taking priority over the mining business in Mali, Niger, and Burkina Faso. I do hope to be able to take that trip. I do hope to be able to sit down with the political leadership in those countries and figure out what the role is for foreign investors like myself. Both Burkina Faso and Mali have been extremely good to me over the last 20 years. I mean, extremely good to me. And I would love, as a consequence of my fondness for their human endowment, which is to say the people there, and their natural resource endowment, to be able to continue to invest there. What I have learned often is that the political and social reality of a country is such that for a decade or a decade and a half, you have to take your leave. And I just like to hear from them what role they consider appropriate for a guy like me. I owned residential real estate in Canada for a very long time. I loved living in Vancouver. I had an office in Vancouver. It got to the point where the government of Canada, the government of British Columbia, and the city of Vancouver put in place discriminatory property taxes against foreign non-residents. And despite my love of Vancouver, when a society tells you they don't want you, you leave. That's what you do. It was harder for me to leave Vancouver than it would be for me to leave Niger, Mali, and Burkina Faso. I just want to hear from the leadership in those countries that they want me more than the city of Vancouver did.
Are you considering exiting those countries right now?
Hopefully not. I have no current investments in Niger. That's the one where the mining law would seem to be most in flux. I do have investments in Mali, in particular B2, and investments in Burkina Faso. My hope is that mining law with regards to fiscal stability agreements in those countries recognizes mining's contribution to those societies, and that they understand that the people who take the risk need to be compensated. Should I learn otherwise, of course, I'll have to exit.
You said you have investments in Burkina Faso. Is that in Endeavour Mining? And what are your thoughts on Endeavour Mining? And do you have a ranking for them?
Yes, I have Endeavour as a 4. I think the political risk is well overstated. I would probably have it as a 3 on the valuation basis, except for that the mine development and management team that I like so much left to go to Montage. I was a huge fan of that team, and I followed them. I'm a decent sized shareholder of Montage. I'm also a small shareholder of Orezone on a valuation basis, albeit I have it as a 5. They haven't delivered the same sort of all-in sustaining cost performance that Endeavour has.
And in terms of Endeavour, they did finish both of their, well, one expansion project and one new mine build on time and on budget in 2024, despite that team going over to Montage. So that is a good sign, right?
One would assume that given the experience that the remaining part of the team has, that they're not second team at all. It's just that I knew the other guys. I could call them, I could get information, I could ask them fairly detailed questions. I could say, what am I forgetting to ask? There was a personal relationship born of knowing them and knowing the old Endeavour senior management team, the financial team, well, that bred a confidence in estimate. I'll need to watch and interact with this team a bit more before I have the same level of confidence.
Do you have any opinions on Ian Cockerill's ability?
I've known him for many years. Ian's problem again is vintage. He's my age. And at a certain point in time, you lose your step. Ian was, he's a veteran in mine finance in Africa, going, back to the Goldfield days and before. Very high quality guy. I'm nervous because I live in a 72-year-old piece of skin. And I'm nervous about the demands on a senior executive who has that same handicap. You have the experience, you have the cunning and the guile. What you don't have is the same step, the same energy. And it's a much harder job than most people realize.
Something about Endeavour, it astonishes me how cheaply they can discover ounces. Like at their new Osisko project that they're hoping to start construction on here within a year or so after they deliver the feasibility study, it looks to be developing into a tier 1 mine, or perhaps a strong tier 2 mine, if not tier 1. And they've discovered that for about $30 million. That's unbelievable. That's one drilling season of a junior in Canada. And then after like 7 seasons of spending $30 million a year, maybe you have a pretty good deposit there in Canada.
That has to do with a couple of things. They're willing to take political risk or perceived political risk. I don't, by the way, consider Canada to be riskless at all. But it also speaks to the prospectivity of West Africa. Archean exploration got underway in earnest in West Africa 20, 25 years ago. It got underway in Canada 100 years ago. And the probability that there's lower hanging fruit in Africa, given the underexplored nature of that terrain, particularly the tough countries, is pretty superb. The second thing is that the Endeavour team has been involved in exactly the same pursuit for 25 years. It's not like they spent time in Canada and then they went to Australia. And then after that, because they liked, mojitos or something, they went to Brazil. And then after that, they went to Ghana. No, they've been in West Africa for 25 or 30 years. They know the mines ministry. They know the prospectors. They know the local elites. They know that one of the ways that you explore is to fly fixed wing aircraft over non-Archean, over known Archean terrain, and just look for a bunch of blue tarps where there's informal miners. When the informal miners have found gold, you find out who the concession owner is. Normally, if you've been in country for 20 or 25 years, you know that concession owner. You make a deal with the concession owner, and then you go back and make a deal with the artisanal miners. This is the type of deep, deep, deep community expertise that Endeavour benefits from. Make no mistake, they didn't discover that deposit, they flew over it. And by the way, by my measurement, I think that absolutely positively has the ability to be a tier one deposit, as I define a tier one deposit.
As a lender, I would like to ask you about gold prepays. So we see a lot of companies taking on gold prepays to fund mine builds. And this really annoys me because let's say a producer has 200 million drawn on their credit facility, and that's their only debt. And then they take on a $400 million gold prepay. And then they tell us that they have $200 million in debt. I'm like, no, you have $600 million in debt. Just because you have to pay the lender back in ounces of gold instead of dollars does not mean that that's not debt. Now, I know it shows up in the balance sheet under unearned revenue, so you do see it in the liabilities. But if you're looking at like long-term debt, or you don't see that there. So
you're exactly correct. It is, from a balance sheet statement, a misstatement of fact. I don't have a problem with gold pre-sales or gold prepays, depending on the cost of the carry relative to your other cost of capital. When non-investment grade mining companies get non-recourse project finance, construction finance, the press release might show 9%. Believe me, including the bells and whistles, it's 15%. And so if your cost of capital on a gold loan or a gold prepay or a gold stream is substantially below the 15%, particularly if there's a buyback, so that you can recapture some of the premium, often it maximizes return on capital employed. It goes without saying that if you employ less capital, your return on capital employed can be higher if you have a successful outcome. It is all about how much gold price upside do you give up relative to your current cost of capital and your return on equity as opposed to your return on capital employed. There isn't a one-size-fits-all answer. I absolutely agree with you that an analyst has to look at the total encumbrances on the balance sheet as opposed to accepting as GAAP the fact that foregone revenue isn't debt.
And something else to consider is as the gold price goes up, like it did, it went up rapidly in 2024. And as the gold price goes up, that liability from that gold prepay, it can be a lot higher than what it's stated on the most recent quarterly financial statement.
Yeah, I tried to say at the beginning of that answer that you need to offset the lack of optionality as a consequence of a gold prepay with the discount that you receive in terms of your cost of capital or your access to capital at all.
Based on past interviews, it seems like you're more inclined to invest in precious metals royalties companies than you are in precious metals producers.
It's really a function of price. The precious metals royalty companies 10 years ago were stupidly overpriced. Hence, there was a great proliferation of new ones. The narrative allowed a butcher, a baker, and a candlestick maker to raise enough money that they could live off their salaries for 3 years. And then the industry fell into disfavor. And so the prices fell fairly dramatically to the point where the market capitalizations of royalty and streaming companies relative to the risk was cheap compared to other companies. With me, it's all about return on capital employed relative to risk taken. The certainty around royalty and streaming as a consequence of no exposure to the upfront capital cost and no exposure to operating cost means that you can do cash flow modeling with greater certainty. If I have a sense that the free cash flow from a mining project will be $1 billion, subject to all kinds of variables like energy costs, labor costs, social rents, taxes, things like that, as opposed to a royalty and a stream that's going to generate $1 billion with no sustaining capital expense and no exposure to operating expense. Obviously, the certainty that I have with regards to my EBIT estimate is much higher with the royalty and streaming company than it is with the other company. The consequence of that, because of that increased certainty, is I can pay a premium. And if that premium isn't outrageous, I'll pay it. I like certainty.
What about the fact that most of these royalty companies are domiciled in Canada, and as a US investor, the IRS probably defines most of these royalty companies as a passive foreign investment company or a PFIC, and these can have extreme tax consequences. For example, let's say we hold triple flag precious metals for 10 years, and we get 5 times our money on that. Well, if you didn't file a QEF election every year and pay annually your portion of the earnings of that company, well, then you go to sell that 10 years later and you're not paying long-term capital gains rate, assuming you hold it in a regular brokerage account and not in a retirement account. But instead, for the most recent year, you pay tax on your gains. Well, let's say you have a $100,000 gain and it's split over 10 years. They take a $10,000 gain per year and apply that to each of the last 10 years. So the most recent year, that $10,000 is taxed at your income tax bracket. So maybe that's 20%, maybe it's 24%, maybe it's 37%. But every year prior, you're taxed at the maximum income tax bracket for that year. And not only that, it gets worse. The longer you hold it, the worse it gets, because you're not only taxed at the worst income tax bracket, you're also paying penalties because the IRS looks at it like you owed that tax 10 years ago and you didn't pay it. So you have to pay the interest for those 10 years. So depending on what the interest rate was, and depending on how long you held that stock, you could be paying in excess of 50% of your gains. So is that a concern for you?
I've been filing PIFIC elections since 1998. What that means practically is that my tax liability around that is, for practical purposes, 7/10 of nothing. Because when you file your first PIFIC election on the first income that they earned but they didn't distribute, you get the tax loss carry forwards from all the years that they didn't make any money. The true downside from a tax point of view is that you always have to file an extension, because in order to make the PIFIC election, you have to have the annual report from the issuer. Your tax return is due on April 15th, and it's usually till mid-May or June that the issuers have their annual report, which means that you have to file an estimated on April 15th. You have to have an extension, and you have to make your real filing somewhere between August 15th and September 1st. Many investors that I know of handle that problem by owning royalty and streaming stocks, both in mining and in oil and gas, in IRAs or other qualifying accounts. I have happily held them in taxable accounts because the nature of my investment and speculation means that I have to file PIFIC elections on all my exploration stocks too. And my accountant thanks me for the extra work. But on balance, those investments have treated me extraordinarily well.
Over the past week or two, I've reached out to all of the companies that I own that might qualify as a PFIC, and all but one of them have gotten back to me with their annual information form to be able to file that QEF election. And I'm just waiting on one of them. So this year, it seems like most of them have it earlier, at least the ones I'm invested in.
There is an increasing sense among, in particular, Canadian investors that U.S. retail investors are 25% of their capital stack, and they have to deal with that need.
We have a couple of subscriber questions regarding gold stocks. What are your thoughts and rankings on Triple Flag Precious Metals and Osisko Gold Royalties today?
I have both of them as fours. I think that those two companies sell at a discount to the normal valuation multiples in the space. Both of them also have reasonable undeveloped royalties, which can add to free cash flow in the next 5 years. And my suspicion is that either the valuation discrepancy between them and larger royal companies disappear, or they disappear into the larger royalty companies. It could be that rather than that, there are lateral mergers, because there's zero doubt that M&A, which is to say building scale, reduces the cost of capital. The arbitrage will either occur in the market as value arbitrageurs go from higher multiple stocks to lower multiple stocks, or the arbitrage will take place in the M&A market.
I have a tough question for you. You're going to have to dig way back into your memory banks to answer this one. But my dad told me a story about when he was at the New Orleans Investment Conference many, many years ago, and he was in a breakout session with you. And you ended the breakout session by sharing your 11th commandment. Now, maybe this is a very bad game of telephone, but do you recall what your 11th commandment was?
I don't.
Bet not thy whole wad. Does that ring a bell?
Bet not thine whole wad. That's correct. I do remember that. I had two 11th commandments. The other was don't bullshit yourself, which is enjoining against hope. But no, bet not thine whole wad is correct. You have to make your allocations consistent with both your financial and your psychological wherewithal. That's important. You can stay the trade if you've made a trade that's consistent with your own risk tolerance. Many investors don't. Many speculators in particular hear a narrative, maybe the silver narrative, and rather than put actualization of that narrative in the context of the risk that they're willing to take, just look at the reward. When there's a bump in the road, they have neither the psychological nor the financial narrative to stay the trade, and they get whipped out of it before, even if they're right, being able to realize the gains that they had expected. I had that experience myself in my 20s, where I made bets that were unrealistic relative to either my financial or my psychological makeup. My psychological makeup was pretty tough in those days, so mostly my financial makeup. And the consequence of that is, although I was very hardworking, pretty smart, I ended up with a negative net worth in my early 30s. I only had to learn the lesson once.
How big of an investment would you make? Because there's sometimes when I feel so confident in something that I'm willing to invest a pretty big proportion of the whole wad in one single investment, but I'm pretty young and I could make that back relatively quickly.
I agree with Buffett. He says that the ideal portfolio allocation is 100% in one circumstance, put all your eggs in one basket and watch that circumstance. But it has to be a pretty good bet. I mean, there have been circumstances. I look back to Ivanhoe Mines in Congo. What could go wrong? Easy, Congo. But the stock was selling at 63 cents. It had 93 cents a share cash in it. It had a bunch of redundant assets, including one that the Japanese had spent $200 million on 10% of. I believe that the stock broke up. Well, 93 cents is pretty easy to figure out in cash, but I believe that the stock broke up, could be liquidated for 2.25. It was selling for 63 cents. I made a big bet. I said, one of two things happens. I either make 63 cents or that stock goes to $5. This is the kind of bet where I have to decide an amount of money that I'm willing to lose all of, because that could happen. By that point in time in my life, that number was pretty big. And it didn't go to $1. It went to $15. So in the right circumstance, I'm willing to go very, very, very big. There was one point in time when Sprott bought control of Uranium Participation Corp to recall it Sprott Physical Uranium. I made a big bet there because uranium was at $30 and it had to go to 60. It had to. And I didn't have to worry about the manager because I was the largest shareholder of the manager. So in the right circumstance, I'm making a big bet with Battle Bank. I love the banking business. I've known the management team for 30 years. So in the right circumstance, I like to take a real, in baseball parlance, I like to dig in my cleats and take a real swing at the ball. There are other circumstances where I'm sort of punting with, 0.1% of my net worth.
Do you want to take a moment to tell our audience how they can get their portfolio ranked and tell them about any events you have coming up and how they can get alerted about when your bank is ready to do business?
Thank you for the opportunity for the commercial. I have for 25 years on a no obligation, no charge basis ranked people's natural resources portfolio. If you like from this interview the way I think and you want to make it personal, go to my website, Rule Investment Media, list your natural resource stocks, and I'll personally rank them 1 to 10, 1 being best, 10 being worst. I'll talk about individual issues if I think my words might have any value. Please, by the way, just natural resource stocks. Please no tech stocks. Please no pot stocks. Please no crypto. Leave an old guy to do what he does best. What I really do best are the Rule Classroom, which is several hundred hours of instructional programming. I guarantee you'll get your money's worth there because it's absolutely free. Go to ruleclassroom.com, participate in the discussion groups, including my own question and answer session most Thursdays, or attend my boot camps, 8-hour-long deep dives quarterly on one topic. Be prepared to work hard at these boot camps. But my premier product is, of course, the Natural Resources Investment Symposium, which I'm informed is in its 30th year. I don't know that to be true, but I'm told that. Simply the best mining and natural resource investment conference in the world. Two critical differences with this conference. One, every exhibitor there is vetted. At every other investment conference in the world, the qualification to be an exhibitor is a check that cashes. At my conference, it has to be owned in an account owned and managed by myself. No guarantee that every stock I own goes up, but there is a guarantee that at my conference, unlike any other investment conference in the world, every exhibitor has been vetted. They are content as opposed to advertising. The other guarantee is even more unique. The only investment conference in the world that I know of that has an absolute solid gold money back guarantee. If you attend my conference in person in Boca Raton, Florida, or via live stream in the comfort and convenience of your own home, know two things. First, we're going to give you 50 hours of hard programming in 4 days, more than you can absorb, but you'll have access to the full conference recording for 12 months, and you're going to need them. The second is probably more important. For 30 years, this conference has come with a full money-back guarantee. If you think for any reason at all that I didn't earn the tuition that I charged you, simply email me and we'll give you back the money. Now, in 30 years or so, I'm told, of putting on this conference, we've had to refund less than 0.1% of the tuition that we've charged. But what this says to you is that the financial risk of the transaction is all mine, not yours. No other conference in the world that I know of has an unequivocal money-back guarantee.
That sounds awesome. I would love to be there. If I didn't have a new baby at home, I would most definitely be there, and I'm going to try to be there anyway, but I don't know if I'll be able to make it. But thanks so much for coming on. I really appreciate your insights on everything. I had a whole bunch more questions. I had 3 more pages of questions, and we didn't get past the topic of gold. So I would love to do it again soon if you're available.
We'll visit with Ms. Callie Farnham, who provides adult supervision to my schedule, and we'll schedule it.
Oh, thanks so much, Rick. I appreciate it.
Thank you. Bye-bye.
Wow, that was awesome. I'm definitely going to have to rewatch this a few times so I pick up on every little tidbit of information that Rick shared with us. Down in the comments and description below, I'm going to put links to get your portfolio ranked for free, and also to Rick's Rule Symposium in Boca Raton, Florida, a conference that I really, really want to go to. And I'm going to try to go to. I'm definitely going to be watching it online, but whether you're going to be going there in person or watching it online, you can click that link in the description. And that link to the Rule Symposium is an affiliate link, so if you buy a ticket through that link, well then Mining Stock Monkey gets a portion of that. It's a way to support the show at no extra cost to you.